address that for you this evening. Can everyone hear over there? Can you guys hear? So, if you want to hear a little bit better, we do have some seats over here. We are going to be playing some slides on the TV. But there has been a lot of confusion, especially with the recent budget that's been handed down. So tonight, we just want to break things down for you and make it as simple as possible. We do want it to be interactive. So we are going to invite you to ask some questions if you would like. Our speakers for this evening, we've got Mark Novak. Many of you will know Mark Novak, who's going to be talking about the property market this evening. We've got Maurizio Zappacosta. Maurizio is an accountant. He's going to be able to answer all your questions about capital gains, negative gearing, and why the budget is as it is. And then we've got Bradley Beers. Bradley's going to be talking about tax depreciation, which before I met Bradley, I thought was a really boring subject, if I'm honest. But after listening to Bradley speak, I realised it's actually extremely interesting. I think you're going to find what he has to say very compelling. So I'm going to hand over to Mark if you'd like to get started. But guys, I want to reiterate, we're going to be doing Q&A tonight as well. So feel free to pop your hand up. Don't be shy. That's what tonight's all about. Over to you, Mark.
Good evening, everyone. Thank you so much for coming. And look, it's been incredible times where, because there's been so much change, people are really open and asking a lot of questions to their local real estate agents, to their accountants, to their professionals about what's exactly happening in the marketplace. And thank you, everyone, for coming tonight. We're also doing it live, so there's a lot of people that are out of the area. I think our record was 7-hour trip to get here tonight from one of our clients. So welcome and thank you for coming. With the budget, it's been very, very turbulent times. It's been times where, which is a really interesting measure, the Northern Beaches with turbulent times. I've been an agent for 33 years. I've been operating DUI for 26 years. And I've been in turbulent times through GFC 1, GFC 2, started within the recession, went through the COVID. And it was really interesting to see how the beaches performed. The beaches always was very fast and reactive to exactly what's happening in the market and the direction the market goes. Whenever I'm sitting with national reps from realestate.com or from Cotality, which is RP data, they're always very interested in what this area does and how it performs. It's first all the time. Our agency is the same. We do particularly well in turbulent times. I think with what your real estate agent does actually matters when times are, you know, when they say with good times, bad habits breed, and with bad times, good habits breed. And I find that a good agent in this market is doing really, really well. So there's some markers that I'm going to show you tonight to look at that you can see with your property and say, okay, this is exactly, I think you're going to feel a lot more comfortable about what we're going through at the moment. I might get a second mic if that's okay. It's just chopping in and out, please. Now, with unlocking that budget, this is good. Can you move us to the next slide, Bids? Right button, left button. Oh, is that you? Okay, so not a sales night, just what's changed and what you can do about it. Guys, if you wanted to just take a seat, relax, I'll be about get comfortable. I'll be about 5 hours. No, I'm going to be 15 minutes, guys, 15 minutes. Just what's changed and what to do about it. So the guys here tonight, the squeeze, 3 changes making it tougher to be a landlord, all hitting at once. What I've done tonight is if anyone has got their phone on them, I'm going to get you to pass. Tiffany's going to pass around a QR code. You can scan it and all of these are going to come up and sit on your phone. So there's a couple of slides I've got. Everyone's got slides tonight. You can go back and rehash on those slides. There's a QR code which is sitting where, Tiffany? Yep, that's here. The guys are going to run those around. All you do is take a photo of it, and then hit send, and then you'll get all these slides coming to your phone. And if you want someone to help you from one of our staff, we can do it for you as well. Guys, land tax. This is the first squeeze that I'm seeing, and I've got to say, you've got to be ahead of the curve with this squeeze. With land tax, it's now frozen at $1,075,000. Why that matters, if you are sitting in a house where you own, if you're fortunate to have bought a second house as an investment, you're going to be paying about $800 a week in land tax now. And because that's now been, that threshold has been frozen, that threshold of $1,075,000 used to go up about 10% a year. So people used to go, oh, I'm not really paying a lot of land tax. You will be paying a fortune in land tax in the next couple of years, particularly as the years roll on and it compounds. I want you to watch your land tax, and I'm going to explain why. Basically, with land tax, if you are fortunate to have a couple of properties and you do go over that threshold, you are going to be taxed. So what you're holding as an asset really matters. The other squeeze to look at is your valuation for 2027 is going to have to be done on your property if it's an investment property. I think bank valuers are going to have a very, very busy time. They're going to have a very, very busy time up until June 27. After that, it'll be too late. I encourage you to get your valuations done now of your assets, and in the next 12 months, get your run done now and not done later, because you won't get a bank valuer or you'll be paying a fortune for them. And you're going to you need that assessment done on your land tax, on your value of your property prior to that date because of CGT and what's coming in there. Also, there's even more tax, which is great news. That 30%, which is going to be changing down from your 50%. So you need to get that val. Make sure. Now, with negative gearing, I wanted to have a bit of a chat about negative gearing. Investors with negative gearing, their cash flow is going to be changed. It's going to be effective about, in real dollar terms, on $1 million property, it's about $200 a week. And it's going to be about 1% if you look at it like an interest rate. So at the moment, negative gearing is going to be available in a few asset classes, and it will not be available on a few asset classes. So it's going to change the shape of the way people are spending their money when it comes to investments or their homes. So how does this affect prices? How does this affect rents? What's going to happen is owners are going to hold on. I think with a bit of looking at how people have operated over different markets, how people, not only nationally but internationally, with changes like this made, and then what actually happens. People hold on unless houses come up for sale. Believe it or not, we've seen it happen already. It happened literally within weeks. So there's a lot of stock currently that's on the market. And there's not a lot of stock being replenished into the market. So they're starting to get this squeeze and this freeze over the marketplace. The big thing and the most explosive thing I want to talk about, rents are going to go bananas. That's a fact. I'm blessed and cursed because I love data too much, but data doesn't lie. And when you look at the rental market in the last 10 years, Northern Beaches only, it's actually, rentals have gone up 50%. So if a property was $500 a week, it's $750 10 years later. So it's gone up 50%, has not doubled. And normally it doesn't. But I think that landscape is going to rapidly change. If it's done that in the last 10 years, I believe the next 10 years, it's going to be huge. And this is what I think it's going to look like. The rental market, there's that figure there, 50% the last 10 years. That's according to all rental properties on the Northern Beaches. Cotality has been kind enough to give us personally, they're friends of ours, every single property that sold and every single property that rented the last 40 years in the Northern Beaches. That's a hell of a lot of information. And we've pumped it all in, and that's what rentals have done. 50% over 10 years. What that actually means is if you go and buy a property today, actually, let's wind back 6 years. If you bought a property 6 years ago, it would then not cost you any money today. And we call that positively geared. So it pays its strata, water, council, whatever your outgoings are, and it's actually positively geared. So you bought it, and then 6 years later, it's now paying for itself. You can actually forget about it for the rest of its life, and it's going to actually look after itself. How good's that? Now, if we go back to the squeeze in that rent in the market at the moment, go back. It's done 50% the last 10 years. And with that squeeze, we're going to hit 70 to 80% the next 10 years. And that's what it's going to look like. You buy a property negatively geared today, it's going to have to be new if it's residential. It's going to have to be new if it's residential, or a commercial property doesn't have the rulings that have just been imposed by the budget. So commercial, maybe a commercial, it may be a new, brand new property. In 4 years' time, it's paying for itself. So it's going to change the way that the shape people are actually buying and their patterns that they're buying with. So the 3 questions I hear every day is, will my tax creep up? Should I sell before 2027? And where should I buy now? So doing it backwards, new builds, which we just discussed, commercial and local units, I think are going to do well. Selling, I think the benefits that you've got, particularly with negative gearing, I think a lot of people are not going to be selling and holding that, a bit like they did with capital gains tax pre-86. People held and held and held as a result. And we tax creep, yes, quite a little creep. You've got to control your tax, and land tax is going to be the one lever that you guys can control. And I do have to say to owners that are sitting on heavily land tax properties, which will be homes, houses, or Torrens or single asset commercial properties, your land tax is going to absolutely hammer you. We did some analysis on a warehouse that we're selling up at French's Forest, and there's 250 properties on that block. There's 150 storage units. There's 100 warehouses. The warehouses are worth $1 million. You could own 10 of those warehouses and still not pay land tax. Whereas you go and buy a house in Narrowena for $2 million, and you're going to be paying a couple $100 a week in land tax. So it's going to change what your tax is my point. Where the smart money goes, the budget shuts some doors and it opens some others. And I think we're talking about those guys tonight. Very important to look at. Shops, offices, warehouses, dodge the rules. Don't like offices, by the way. There's an asset class not to get into. Don't do offices. If you look at how it's trended, Michael, back me up on this one. It's been, yeah. Good for your business if you want to put your business in it, but in terms of watching it go, it's not going to happen. Brand new's the way. Less land tax. So again, going back to that example of the warehouses or units, like if you're buying in these big unit blocks like across the road, you got this immunity on land tax. You're much, much more protected. The numbers still stack up, and I'm really passionate about this. So same property unless of your cash. Now, again, looking at that information about putting your money into property. Today, if you put in, it's called IRR on your money, your internal rate of return on your cash. And people look at it and go, I don't understand why there's stocks and they make 15% or 20%. And I don't understand why there's, I can buy crypto and it's going to do these amazing things. Agents or the industry doesn't illustrate how well property does when you put in a small amount of cash. This is an example of it. And this example is true and real to Northern Beaches. All of this data is only Northern Beaches, and it's historic. Unfortunately, if I had the future, probably wouldn't, the future data, I was a fortune teller, I'd probably be doing something else. So let's put in 20%, let's put in 10%, and let's look at our money. Thanks, Bids. Okay, so we put in our money. We put $27,000 in. North Curl. This was a property that was purchased. 27,000 deposit went in, and 20 years later, there's 2 million in equity. Geez, that's a long time. That's a long time. That is the theme. Time. So 18% return every year on your money. This was a bad one. This was my one. I own this property. But if you do the average data, it's much more powerful than that number. I just got in love with the ocean views, rented it ever since, but it was not a top performer, but it was an excellent performer still. Okay, houses up, units up. Do I buy a unit? Do I buy a house? That's the data. That's 40 years. That's Northern Beaches. They're the same. But guess what's happened in the last couple of years? Big difference. Houses have surged. Units have not. If you look at any house suburb on the Northern Beaches, any Collaroy, Narrowena, Freshwater, those guys, they've done 125%, 115%. They have doubled and a bit in 10 years. If you look at units, DY, Collaroy, Freshwater, Manly, they've done about 50 to 60%. Vastly different. So I've never seen a bigger gap between units and houses. And again, the units, that's another good reason to be getting into units. All right, guys, don't forget you got until July to get those valuations. I think I've jumped a little bit. My favorite graph that Lisa loves has not turned up, but it shows you 40 years of Northern Beaches real estate. But again, you can see that growth. So guys and girls, hopefully that information helped you tonight. Keep away from land tax. It's going to, that's going to be probably, I think, your biggest enemy. Commercial is going to be good because it's got your negative gearing benefits. Brand new is going to be good because it's got your negative gearing benefits. I still love my local units. I hope I helped everyone tonight. We'll do Q&A afterwards. Something I wanted to also mention is we're going to run a very quick workshop for 15 to 20 minutes on commercial, and another one with Billy on first home buyers if you're trying to help yourself or your family. I want some advice. So we'll split away just at the end if you want to have a chat with those guys.
Thanks, Mark. I think we should do some Q&A now, just while people might have some questions top of mind about the property market. There's been lots of change. What we've seen on the Northern Beaches is the market has dipped around 7% is what we've seen over the last, I've got a really bad mic here, over the last sort of 7 to 8 weeks, I would say. Bad mic. This is a bad mic. Sorry if your name's Mike. Let's try another one. Good mic. Really? Okay, who's got questions, guys? Someone must have a question. You guys are here hungry for knowledge. Questions for Mark about the property market?
Hi, Mark. I just had a question to do with looking at the apartment market. Can you divide it up into what's predominantly investor focused versus, say, owner-occupier? Prices are more likely to be affected by investors, because they're in 1 or 2 bedroom units sort of market rather than a 3-bedroom, or can you give other definitions of sub-markets, I suppose?
Yep. Again, when I had all that data from Gertality, we ran through 1, 2, 3-bedroom rentals. 3-bedders came in at a 4% return gross over the last 5 years. 2-bedders came in at a 4.5% return, and 1-bedders came in at a 4.8% return across all Northern Beaches. So yeah, very good. The rents in terms of the capital growth, well, the value of them is all going to be, I'd suggest would all be, there's a lot of scarcity across all of them. So the values are going to excel just as much in owner occupied areas, in investor areas. I've always enjoyed observing snobbiness with property purchases because I live in this suburb and it's always does better than that suburb. You know, DY used to be like that, but not as much now. Freshwater was always great until, but you know, DY started whipping freshwater with rental rates. We get a better rent in DY than freshwater gets. So, you know, I think capital growth, everything's very similar between all the units, whether owner occupied style or investor style. Does that answer your question? Yep.
I was just wondering. Yeah. I was just wondering about going forward, whether there's more likely to be from investors sort of holding on or whatever you were saying, you know, versus different other parts of the market. Is there going to be like lack of a supply in say 1 and 2 bedrooms?
Yeah.
Or is there going to be a lack of demand, or is there likely to equal out? You know, could you see, you know, that gap housing to unit differentiate depending on the unit market and whether it's a 1, 2 or 3 bedroom, and how it might then relate to a house?
Yep. I think landlords are gonna make a fast exit out of houses. They were good when they lived there, and then they moved out, and they were good with rent. But I think capital gains, land tax is going to catch up on them. So and then I think with units, I think it's going to be explosive. I'm really, really, really bullish with that rental market. It's been really hard for a landlord every year for the last 20 years. We introduced an interest rate of 0.5% more because you're a landlord. And it was like, hang on a sec, I've got a rent. And it was like, now you can only tell your tenant to put your rent up. You can only put your rent up on your property once a year. Hang on, no, now you can't take a higher bid or say offers over. You know, there's been 20 or 30 layers of legislation that's hit landlords that if it's too hard, they won't go into the market. But I don't see them leaving the market because they're getting such good rents. So I think that's going to be an explosive market, that rental trajectory. And I think the units are going to do well with values because they're so underpriced. And I think the houses will just not level off more than what they have. And Connor, you had one.
Mark, probably for both you and Maurizio, just a question about so the land tax, right? And you've mentioned the land tax is going to be going up. Obviously, there's been negative gearing offsets to benefit putting things in your personal name across multiple properties. Moving forward, I guess, do you see a benefit to structuring purchases for residential properties in companies to try and minimize land tax? Because I know if you set them up certain ways, the purchases, you can basically say that they're different entities owning different properties and reset your land tax threshold.
The only issue with that is that the land tax for each entity, a company, is at $1,075,000. That's going to stop there. But then you don't get any at the moment, or with the CGT changes. A lot of people are thinking about using company structures because the money's quarantined in there. You can buy other properties. You can offset the other properties. The negative gearing doesn't stop there because it's a separate entity. But if you, like what you're saying, but if you buy new properties, at least you'll get the benefit of the negative gearing. But with a company structure, the negative gearing will follow your property. If the more properties you buy in that structure, it stays in there. But the only issue is that it will take time for the interest rate, the return, to start to become positive. At the moment, it's taking 4 to 5 years. Without the offset, it might take 6 or 7 years. But it's all quarantined. It's just tax deferment. That's all the government's doing, is deferring the tax refund to you guys. So when you buy a property you can't use the negative gearing, it's a forced saving. You're not getting that 5, 10, 15 grand a year refund. You get that when it starts making money on year 6 or year 7.
I think that's a good segue into your talk, Maurizio. Mark has something else to add.
If I could just add one thing, superannuation is, if we're talking about rents being bullish, superannuation is even more bullish. There's $4.4 trillion in super. As a metric, there's $10 trillion in Australian property in Australia. We have in savings 4.4 trillion. Our Australian stock market, the ASX, is valued at about 3.8 trillion. So our super in cash is bigger than our entire stock market of Australia. Why am I telling you this? It's been half pregnant since 1992 when it started, and the baby got bigger and bigger and bigger real fast. We were charging 3%, then now we're at 12% that employers are paying for their into employees' accounts. The average amount is $185,000 cash in the average Australian's super. The baby is ready to come out and buy property. So I think in terms of structures, I think we are going to be seeing people coming into that rental market with a different structure that they never would have thought about before. But they're like, hang on a sec, I can't buy anything for 185,000, which is the average person's super, but I can borrow 400 and then I can buy something for 600. What can I buy for 600? Or hang on, my wife and I, we've got 180, say 200, we've got 400. Okay, we can borrow 600. And it doesn't affect our mortgage. If you borrow something in your super, it's like another baby being born. It doesn't affect your lending. You know, if you go to get a lease for a car, go to buy a home, it's completely quarantined away from that lending as well. So I think in terms of structures, there's sort of there's business ones, and then I think there's just organic ones, which is your home super. It's going to be ballistic.
Okay. Oh, we got a question. No.
Yes.
Units are going to explode.
With rent.
What about brand new strata title duplexes?
Yeah, I think so. Yeah, I think strata title duplexes definitely. Again, they're reducing the land tax. It's going to be half if there's two. New, good. If they're new, because they're going to sell well because they're going to get new building, the depreciation and the rents. I think will do well. Same as I think they'll do similar to units more than houses. I think houses will level out a little bit. I'm not bullish on houses in the next 3, 5, 7 years, but I'm really bullish on units in terms of values. Duplexes is going to sit probably almost in between houses and units. They're all going to do well, but I'm just looking at the data. Pleasure.
Can I ask the question? In terms of the structures, a family trust or property trust, company or superannuation, which is the best structure to own a house?
That's a very tricky question because there's so many different combinations. Like if you buy in a family trust, it's 30% tax, no matter what. So if you make $100,000 after rental income, you have to distribute that 30% tax straight away. So even though husband and wife have got a few properties at 80 grand each, they'll be paying the higher rate of tax. So you just got to look at every different combination. Like as Mark said about superannuation funds have got a little bit of an advantage, but you just got to be careful. My only issue with self-managed super fund is that you've got to be so careful about portfolio management and understanding your asset base, because there's so many people out there set up self-managed super funds, 5 years later, 15 years later, they're not achieving their targets because they overspent, overborrowed, and not following the right program. But people that follow the right program, their self-managed super funds are doing fantastic. So back to your question, which structure, it just depends on your circumstances. We just got to look at each one individually. The company structure is okay, but long as back to the portfolio manager, if you buy a few rental properties in there, buy some shares, then you're using the franking credits of those shares to offset some of the income of loss on your property. So it can work. So it just depends on your asset base, your goals, and where do you want to reach your targets. But just, I reiterate, doing anything in your self-management is a good structure, but you've got to be really careful.
Okay, over to you, Maurizio.
Alrighty. We've got a few slides up here, and I left a few 2-page notes on the chair there. What I would like to start off with is I say, with all the changes that's happening, I just want everybody in this room to be prepared. Be prepared for the tax, the funding requirements, and the value creation. Just be aware of what's happening. Because with the tax, if you buy a property that's not new, your refund, your tax loss is quarantined. That means you don't get the benefit of that, as I said before, 6, 7 years when that property becomes profitable. It's a forced saving, it could be good, but you've got to make sure that the asset class that you purchase, like there's so many residential old, residential new, commercial old, just got to be really careful about which properties you go into, and each one of those asset classes has got different tax benefits. So it's all about, with these guys here, making sure you buy the right place at the right value, and the growth happens over a long term. You just don't buy for a 2-year or 3-year. It's always going to be a 5 to 7 year process. The other point is just to understand the market and just be really cognizant. I believe there's not going to be the fast gains anymore, like people doubling their properties every 8 years. Certain properties might do every 10 to 12 years, but it might be a longer process. So we just got to be cognizant of what's going on in the market. And with the tax laws changing, like even today, they changed certain aspects of small business capital gains tax from 2 million to 10 million. So it's going to be a revolving and changing environment. With the quarantining of negative gearing, that's the most important part for everybody to understand. You buy an old property, the losses will follow you around until it becomes profitable. So you just got to be really cognizant that when you're buying something, just don't think you're going to get your tax refund. And especially in the marketplace, since the budget came out, all funders have reduced their borrowing capacity by 20%. So that means you've got to put more money into the transaction and just got to manage the whole process in a more cognizant way. And the other issue is that just to make sure that 1st of January 27 is a minute away. So I believe you should start getting your valuations process, start talking to people, getting a relationship with a valuer. I would even get a valuation at 31st of March, then another one 30th of June. So you're fully aware. I know the ATO are going to come out with some tax valuation kit, but I can guarantee you they're not going to be great. They're not going to be on the benefit of the taxpayer. It's only the benefit of the tax laws. Yes, I know. Okay. No, it's an investor. Yeah.
Thanks, Bids. I know people are going to have lots of questions. It's been confusing, the budget, definitely. And as Maurizio said, it is changing. Like today, there was a change that took place. A change for small business.
And the main thing is that the CGT was pretty easy to calculate before. Whatever your profit was, if you worked it out, you made 100 grand, it's going to cost you 25 grand tax. Now, the minimum, it's going to cost you 30 grand plus, 30% plus. So you just got to be aware it's going to add 20% tax bill to everybody on the capital gain tax going forward.
Okay, who's got some questions? I saw a hand.
So they're going to change it. So if you sell a property now,
Yep,
you only get taxed on 50%. Is that right?
that's exactly right.
And that's going to change.
That's exactly right.
So really you need to sell it now if you want
No.
to save 50% of
If
your
you were to
tax.
say no, but if you get your place valued as at the 30th of June 27,
Yes.
1st of July, you get that uplift. So if you bought a property for 500 grand and now it's worth $1 million, get the valuation document saying it's $1 million. So you start your base number at $1 million 1st of July.
Right. So, but
Yeah, the grandfather.
so if you sold it, so if you bought it $1 million, if you sell it after July,
So you sold it after July?
Yep. You've got to be paying 100% of tax
Or
on that.
a minimum 30%. If it's worth $1 million, 30th of June 27, and you sell it for 1.2 afterwards, it's a minimum tax of 30% on the 200 grand.
Right. Okay. So you don't get any tax deduction. Yeah. As far as before, it was 50%.
No, but you're getting the benefit of the 50% because you're getting it valued.
Mm. Okay.
Oh, Billy's got a question. Incidentally, after this, guys, we're going to do a little breakout thing. Michael Bergio from Commercial will be here, and Billy is going to be talking about first home buyer and off the plan.
Maurizio, what does the valuation need to look like? Is it a
Full
refinance?
blown valuation can't be a drive-by. It's got to be fully documented, able to take the ATO to court.
Right. Okay.
It's going to cost $4 or $5 grand for valuation.
Best person to organise that for you, is that get in touch with the broker? Who's your point of contact? Who's doing this?
Yeah, we're going to have like I'm discussing with Mark, we should have a panel evaluation for the Novak clients, so we can start that process and try to get the price down as low as possible for doing the project, and try to get two the numbers, one at 31st of March and one for 30th of June, so we can understand what the valuation is going to be, because the market changes all the time.
Thank you.
What about the grandfathering?
Yeah, the grandfather stays in place. There's no issue there, but you've got to get the valuation of that 1st of July 27. You must have it done there. You can't wait 5 years later. You do it now. It's got to be contemporary. ATO was always want contemporary documentation. Then you'll have to argue with the ATO if they don't agree with it. If they've got their ATO tool and they're saying the valuation's 1.2 and you're saying it's 1.5, it's always going to be on the onus of the taxpayer to argue it. Sorry?
What if you're a month late on your valuation?
A month? No. But don't be late. You've got a year to do it. Just don't be late. It costs you money. It'll cost you money.
Okay. Do we have any more questions, guys, for Maurizio?
Hi, if we use the previous example, 500,000 buy, it's worth $1 million at 1st of July 27, and then you sell it 1st of July 29, but it's only worth 800,000. So there's negative equity of 200,000.
The capital loss, yes.
Okay, so then that $200,000 capital loss is then applied against the.
No, that capital loss will just follow you around until you make a capital gain. So
You've still made a net.
Doesn't matter. It's a capital loss, can only be offset with a capital gain. Cannot be offset with revenue, like you personally.
No, but you bought it for 500. You bought it for 500.
Yes.
It was valued at $1 million, and then it's 800 when you sell it.
Yeah.
So we're talking two different periods. So basically, between the time that you sell it and the valuation of 1st of July 27, you've made a capital gain, a gross capital gain of 500.
Yeah.
But then it's
So
reduced
you're
to
saying you
200.
make 300 grand, and on that 300 grand, you bought it before that time, you'd be taxed on 150 at, so you'd pay about 30 grand, 40 grand capital gains tax.
So just to clarify, the 500 capital gain between
Cost
the
base.
500 and the middle, and that's at 50%.
Yeah.
Is that right? Because it's grandfathered.
Yeah.
And then you've got that $200,000 capital loss that can be applied against the.
Yeah.
Okay.
Yeah.
Okay. Anyone else? Do you guys have questions over here? No? All good. Okay. Mark's telling me to follow this. Would you like?
So just on the old deal, Maurizio, the grandfathering we've talked about. So the new builds self-manage funds, the changes. So brand new homes, good. Companies, no change at all.
Well, the
Is
company's never had capital gains tax, so
Okay.
that's why it stays the same.
nice. And self-managed super held inside, not touched.
Not touch. But back to self-management, just got to make sure it's the right dynamics and the right balance sheet before you go in. Like, I just wouldn't like anybody in this room to go to a super fund strategy and borrow 70, 80%. In super funds, you just want to get to 60%. So it makes a profit sooner for you for your sole purpose test. It's there for your retirement. And that's what a lot of people miss, the sole purpose test. It's there for your retirement.
Okay. Now, holiday homes, there's been some changes with holiday homes.
Yeah,
They're getting a bit nasty.
yes, with holiday homes, you just got to make sure that you don't block out prime cooking time. You make sure that it's available to rent all the time. Because if the ATO finds out, and they can easily find out, if it's booked out for a month from the 15th of December to 15th of January, your place at Palm Beach, it's purely not a rental. And then that will affect your deductions. You
They
get
come-
discounts.
They're coming to get you.
Yeah, you just got to make it available all the time. So it's just in time management with holiday houses. A week before there's nobody there, then you can take it on, not blocking it out a year in advance.
Okay. And there's some other stuff with electric cars, a couple of quick wins there with some tax for workers. Family trusts.
So with family trusts, it's at 30% tax hit. You just got to be really careful who you distribute it to, and just to make sure that those beneficiaries that are getting the money are paying 30%. Because previously they would have been paying 15%, 12%. Now they're going to get hit. So just got to be really careful to distribute in a different way.
Except for the farmers.
Yes, that's right. Yeah.
That's good. I like that. Okay, so you got some dates here for us.
Yeah. That 1st of July, 27 date is so critical. I can't harp on it. It's critical date. Don't wait 4 years, 3 years to get a valuation when you're selling a property. These dates are so critical, because if the tax office will just put their judgment on it using their calculator, then you suffer what they say.
And just to be really clear, if it's a secondhand property, it's good news for you. You don't have to dispose of it. They're going to grandfather it, just in case some people don't have that real clear.
Thank you. Thanks, Maurizio. Guys, any questions just before we move on to Bradley? Oh, we've got some more. You're very popular, Maurizio.
Hiya.
Hi.
I just had a quick question. If I had 3 evaluations for a property and they were all different, is there a median percentage where you're not going to trigger the ATOs? Oh, that seems a bit odd.
As long as they're reputable valuers and they're not dodgy valuers, yeah, you'll be okay. As long as within that 5 to 8, 10% mark, as long as it's close. Long it's when they're 20, 30% different, that's when you start to have an argument.
Just want to ask another question. What happened to your arm?
Old man problem. Crossing the road, I tripped and tore my cartilage. Thanks, Mark.
Hi, just one more question, sorry. New builds.
Yes.
The definition of that, I'm thinking if someone's bought off the plan and then you buy it from them before the building's been commissioned for occupation, are you buying a new build, or because you're the second owner, it's not a new build anymore?
That's a very interesting question. It's got to be some sort of grandfathering procedure. If it's new, I don't know. I can't answer that question.
Okay, thank you.
Bradley might know.
Bradley.
Yeah.
Come on up, Brad.
Yeah.
Come on up. All right. Over to Bradley, guys. Tax depreciation. We're in for some fun. Yes.
Thank you. Stay in the middle. I don't think I needed somebody to make it taller.
We were worried when we did this today about you. We were worried.
I would have hit my head. Anyway. Nice and close. Do we have any slides here? Great to be here. Thanks for coming out to learn about tax and budgets and fun stuff. Thursday night, isn't it? What I'm here to do tonight is to talk to you about depreciation. It's something that I've been in for 28 years. I've been at BMT, and we've worked with close to 1 million investors in doing depreciation schedules now. And what I have found in that time is that so many people don't take full advantage of it. We're talking here about lots of things. How do we not pay more? I hate that land tax. How do we not keep paying more land tax? How do we minimise the taxes that exist? But one thing that's not done as well as it could be, I would say from my time that around 70 to 80% of investors are not claiming all the depreciation they can claim. We're giving it to the clowns in Canberra, and I don't think we should any more than we need to. So what I'll do, and I'll get a bit of time to go through and say, what happens if you do it? What happens if you don't do it? And I can help you with the number to make it as best we can. So we'll give you a little bit of technical so you got some understanding while you're at it. I can't even see those slides. That's a bit of a problem. Can we swap? I'll come stand down there. I don't need to be up high anyway. I don't need to stand up on top of something. Am I just getting old? What is it? Wear and tear of a building. So we understand depreciation if I talk to you about our cars, because we drive it out of the shop and it loses value, right? We all understand it that way. With property, we're buying it to make it, oh, thank you. We're buying it because we want it to appreciate or go up in value. But the carpet, the stove, the bricks and mortar actually wear out over time or decline in value. Your carpet wears out like your car does and goes down in value. So you get to claim a depreciation as an investment property against that wear and tear. Is this mic no good? It's all right?
No, it's good. Yeah.
It's the second biggest deduction that you'll make on an investment property. It's about, on average, last year for the 45,000 of we did in the first year, about $12,000, $12,100. So it's a big deduction. We look at the things that we're trying to make deductions for, the dry cleaning, the this, the that make a little bit of difference, and they all do add up, but depreciation is not done as much as it could, and it's an average at $12,000 in the first year last year. So make sure you're doing it. Second biggest deduction you'll ever make outside of interest. Who works out the numbers? Why am I here? So depreciation is one of the numbers that goes into a tax return that the accountants put together for us. I'm a quantity surveyor. I'm not an accountant. And a quantity surveyor is someone who estimates the construction costs of buildings normally. The claims you make relate to the construction cost of the building. And so we're the guy that knows how to estimate the construction cost. The tax office accepts us to do those things and come up with those numbers. On top of just knowing that that's what we can do, we also have the fact that we're affected by the tax office first, but also how do we get the most out of it? How do we squeeze all the deductions we can by knowing all the rules and knowing what we can and can't actually do to get those numbers out of that property? Now, I'm going to run a cash flow here, and I think the easiest way to give an indication of what happens if we do or we don't claim depreciation is to go, let's take a little simple scenario on a unit here. And what happens to the numbers if we claim depreciation, and what happens to the cash flow if we don't? We're buying properties to make money out of growth, out of cash flow. This makes a difference. I'll show you how it works. I took a project here, which is actually just up the road because we've done some schedules in it. I didn't put a unit number on it because someone here might own it. But let's just take, I think I've seen one for sale. Oaks up the road here in DY, $1.3 million for a two-bedroom unit. The rent for that's about $1,150 a week. So what that means is, I go a little closer. So in order to keep this property, you're going to have expenses. They're going to be about 59,000. I think I got it the wrong way. The rent at 1,150 is $59,000. Some expenses in order to, sorry, I've changed those numbers around a little bit and I've confused me. You messed up my slide. You made him look good in Novak, but yeah, you've lost me a little bit. Yeah, exactly. Less than I had to do it. So we have some rent there. It's like $59,000. We're going to have some expenses we need to pay in order to keep this property. Interest, rates, land tax. Let's say that's about $75,000. So in order to actually own this unit at the start, we're going to have to kick in about $15,000 a year, which is not ideal because it's, $300 a week or whatever it is. So it's the money we've got to kick in. Now, under the current rules, we get to make a deduction, and I can't really see any of those anymore. We get to make a deduction against that. Am I just getting old, or is it just me? So we get to make a deduction for that $15,000, and once we make a deduction for that $15,000 with our normal marginal tax rate, we'll end up with an after-tax cost of about just under $10,000 because we'll get about $5,000 back from our tax. We're going to have to use round numbers because we can't see more. We'll end up with about $5,000 back. So our $300 a week will drop to about $200 a week. If you can see those numbers exact on your slides, that'll be a little better. But then we make a deduction here, and we think the deduction out of a new one of those properties will be about $19,000 in depreciation. So that's the building getting older, wearing out, deductions there of around $19,000. What that means now is we're going to make a full deduction of about $34,000. We're going to end up with about $12,000 back in our tax by claiming this depreciation. The difference in these numbers is that with the depreciation that we claim is a non-cash tax deduction. It's the building getting older, it's wearing out over time. We're not paying it out like the rest of those expenses. So it makes it a much more lucrative situation. Now tax back comes back to about $12,000 or nearly $13,000. So the cost to hold this property now is $2,400 per year. It went from 15,000 down to 9,000 with a deduction for our losses, down to about 2,400 after we've claimed depreciation against it. My job on this whole page is just to make that number as much as possible. That $19,000 that we've calculated as a deduction that you can get makes such a substantial difference to that numbers. 9,600 goes down to 2,400, whatever that is per week. It's about $50 versus about $100. So it makes it, $200. So it makes a very substantial difference to the actual cost of owning that investment property. Lots of you might be here tonight, own a property that's like that, a new property, second-hand, new property here. If you haven't actually done that property and got the most out of that, you're kicking in you're nearly 10,000 instead of kicking in your 2,500 and leaving the rest of that with our mates in Canberra to make good decisions on where they spend it. Now, second scenario, I won't go through in as much detail. I wonder with a second-hand property, what I want to bring to the attention is, where are we? Next, I need to hit the next slide there, do I? How do we go here? Age doesn't rule you out. So a second-hand property doesn't get as many deductions as a new one, but it does get some deductions. They are less. They're not like $19,000 like the first one we looked at there. But I've taken another scenario here of a slightly older property. It's about a 20-year-old property. I remember all my own slides now. It's about a 20-year-old property purchased for $975,000. Gets rent of about $900 per week. So your rent is about $47,000. Expenses about $57,000. The detail is all in the slides. You can see a bit closer when you download them on the app there. What this means is that you're going to kick in about just over $10,000 in order to hold onto this property at the start in cash. So just under $200 a week at the start. Now, what happens after we make a deduction for that loss, if we can get to the next one, works for me, is that we end up with some of that back. We're going to end up going to cost us about $6,500 per year once we've made a deduction for the losses that we made against that property. Now, on this older property, you can see the deductions here are about $8,000, not $19,000 like we had on the new one. They're about $8,000. So not as much, but it still makes a substantial difference. We're here now kicking in $3,300 from the year instead of what started with $10,000, went to $6,000, goes down to about $3,000 as the after-tax cost or the money we've got to stick in there each year. That would make that my life. There we go. Look at that. I'm going to plug that in. We're kind of through that now, Mark. That's good. I've now got those numbers. Now, what will happen with this second-hand property with the budget changes that have just happened is that we don't get to make those deductions in depreciation or the losses for that negative gearing that we talked about. So we're going to end up back at, is that going to plug in? We're going to end up back at that property. Please be nice to me. Oh, look at that. That was so much easier to see. So we're at 8 Oaks Avenue. So they're the real exact numbers. Happy to share those original slides. Mark will do that for you. Can we mirror that one as well? But so we went some round numbers on that scenario. Go through that. The other thing I've got is a little app that you can get for free called PropCalc that you can do this on your own properties. You should always, I think, learn how to run a cash flow so that you go to your accountant actually armed with some idea of what the cash flow should look like. And before you're buying, understanding what your cash flow should look like, one of the things you're going to need for that is depreciation. Can we actually go to the next? Oh, is this still going to work? No, it's not. Okay. Let's go to the next one. The second scenario. Yeah. No. Clicker? No, I got no love. No, we'll go back to the original slides. Is that the best one? We tried. Yeah. Yes. Absolutely. Not straight away, but you can definitely depreciate. So anything that you add to a property, you have, so depreciation is related to the cost of what's there and the things that are in that property. If the stuff is all new, you actually get to claim it based on a new property. If the stuff is secondhand, you get to claim some on the structure, which we'll get to in a moment. We get some slides back at some point. Some on the structure, some on the plant and the fixtures that go into that property. If those things are secondhand, which is why that secondhand probably doesn't get as much as the new one, then you can't claim on some of those things. But if you put them in yourself, you're putting new things in. It's like if you add something to your car, you've actually got something new in your car. You get to claim against that new thing you've put in that car. Same as if you put a new thing into your property. No, because you've actually spent more money on it and you've put more things in there to depreciate. You can't claim them instantly if they're improvements. If they're repairs, you will claim them straight away. But if you've actually improved the property, you need to add them and claim them and depreciate them over time. This depreciation in the first year I've got is $19,000, but it actually goes for 40 years on a brand new property. Depreciation's got two areas. I'll start talking about some of the slides if we find them, we'll get to them. And that brings to that. We're working, are we? Fantastic. Does that mean this is going to work? No. Okay. This is the second-hand scenario. We said we lost $10,000 or about $196 per week. Second-hand scenario we did talk about. Can't see them over there. What will happen after those budget changes is you'll have to keep kicking in that $10,000 each year until you do become a positive cash flow property, hopefully over 6 years, I said earlier, and that will make some difference to that. Can we have the next slide, please? Is that going to work for us? Is it going to keep going through? I think we've covered that one. It's about $3,000 a year difference. Next one, let's go again. I'm going to kick over that because we've done the budget changes. Next one. Right. To your question, depreciation's got two areas, which is where we'll talk about. One goes for a claim on the structure of the building. Concrete floors, walls, roof, things that last a long time. If it costs $1 million to build the structure, you get 2.5% or $25,000 per year against that structure. In order to claim that, it needs to be built after 1987. So it doesn't have to be new, but it's got to be built after 1987 to get this piece of the structure. If you put a new bathroom in, it's seen as part of the structure or part of these things, and it's new, then you'll claim your new bathroom over the next 40 years. The other component of depreciation is what's called plant equipment. Carpet, stoves, blinds, curtains. There's about 170 of these things. The tax office puts a list of them out there, and you get to claim them quicker because they don't last as long. 8 years, 10 years, 12 years, they put a life against them. The difference with these things, in order to claim them, they need to be new. Those things can be old, as long as they're built after 87. These things, they need to be new. Either you put them in or you bought a new property with them in there, yes? Buy it before 87, your depreciation's run out. This depreciation starts for you when you buy the property. If you bought it before 87, your depreciation's probably all claimed by now, basically. Next slide, if we could. What sort of deductions come out of properties? Relevant here. As I said, the new ones get the most. About $18,000, we can see at the bottom there, is the average in the first year out of the properties we did last year, which is about nearly half of the properties we actually did last year. So new gets the most depreciation deductions. Old properties built before 1987 that have been bought, and we did something for them recently, still got an average of about $4,600. So if you've got an old property that's built in the past, you may not get some of the original structure, but someone else may have renovated it 10 years ago. So you may get something for that. You won't get anything for the plant and equipment that's secondhand, but it's some of the work that's been done potentially by other people. We can see the sort of deductions that come out of these nearly new properties. Not as high, few of them, $8,500 over the 17 to 21 that are few years old. Next slide, if we could, please. Renovations. You talked about renovations. There's two things to consider in renovation. Firstly, 2/3 of the properties we do have had some sort of renovation after they were built, which means there's more deductions in them than just what was built at the start. So the important thing is we go through it, we find those things, and we make sure you get those deductions out of those. We'll go to the next slide if we could. There's two things I want to consider about renovations. The first one's an easy question. You spend more money on it or someone spend money on it, there's more stuff being put in there, so there's more things to depreciate. That's the thing to consider. But the other one I want to talk about is scrapping. If you're a renovator and you've come and you've renovated a property, before you rip it apart, there was things in there. They may have had some embedded depreciation in there. They may have had a kitchen in there that's 20 years old. Let's say 30 years old, 20-year-old kitchens, not throwing so many of those away, but 30-year-old kitchens you may be throwing away. That kitchen still has some tax life left. Before you throw it away, make sure there's some depreciation value on that, so you can make sure when you do scrap it and there is some value left, you actually get to claim that. The thing to think about there is just make sure the quantity surveyor has done something on it before you rip it apart. If you're renovating, next one, if we could go. Important for renovations. Does work for residential property as well as offices, retail, every type of properties. We do everything from the pub. My surname is Beer, so we like those. Pubs, farms, hotels, motels, the Melbourne Eye, the big rocking horse in Adelaide, all those type of things get depreciation schedules, which we've done on. The average first year deduction out of last year in non-residential property is just under $60,000. Bigger money spent in construction on these things, so there's more deductions available. The other thing is they don't get caught up in the negative gearing laws. They also don't get caught up in the second-hand plant and equipment rules. Remember I said your carpet has to be new to claim it? In a commercial property, it doesn't have to be new. They didn't do that for the commercial properties. So if we go into a commercial property that's 5 years old and we see carpet that's in good condition, we put a value on it, as a second-hand owner, you get to claim for it. So it's another thing with a commercial property that means the deductions for depreciation are a bit higher. Next one, if we could go. You'll probably hit that so they all come up. There's a page of them. A few questions you'll ask. You say, what are you doing, Brad? Don't I have an accountant? I've got a good accountant. Don't they look after all my tax stuff? And the answer is, I'm sure you do have a good accountant. We're not the accountant. We work beside them. We come up with this one number for depreciation and give it to the accountant. Most of the time we work for the accountant. Or when I say work for the accountant, we work for you as the property investor, but the accountant's the one that said you need one of these things and it saves you lots of money. And that's why you think your accountant's awesome. But we found you $15,000 or $12,000. Old property still gets it, not as much, but ask the question, is it too late? You come here tonight and you found that you've got an investment, well, you probably knew already, you've got an investment property, you found out depreciation is important and it wasn't quite new or something like that. You can actually go back to the tax office and say, you know what? Last 2 years, I didn't claim this depreciation because I just didn't know. You can go back and amend some tax returns, potentially get some money back from the tax office. We like money back from the tax office, don't like leaving it with them. Capital improvements versus repairs. If we repair something, we can write it off straight away. If we improve something, we need to depreciate it over time. We'll separate those things. We'll work with the accountant on which one should be which without on the money that you may have spent on one of your properties. Capital gains tax. What you claim does affect you. There's enough mess around with capital gains tax tonight to give you a white paper and not talk to you some of the depreciation components of that. Let's move on. Things that need to, we might hit that again. I'll run through those very quickly. A report should last for 40 years. Give you all the things you need. Different rates for different things. Diminishing value, prime costs. You want to read about those in detail, feel free. If you're an accountant, you'll understand what they are. We give you all of them so you know what to, so you can make a decision based on what your financial position looks like with your accountant to work that out. Split reports for multiple owners, they split them up, give you copies, access to my BMT, if we could go again there on another slide. We're going, yes. That can actually help you to update your schedules, share things with your accountant. The more plan we can find, the better. Knowing what the rules are and the way we cost things for depreciation is different to you just going and buy it from the shop. I guess the important things that need to be done within the schedule. Next slide, if we could. Average first year, about $12,000, as I said. Guarantees. If we go to your property and we can't find anything, we're going to ask a few questions before we go there, by the way, about what it is. If there's nothing there, it doesn't cost you anything unless we're actually going to find some deductions. So if we think there's deductions, based on the conversation we have with you, we'll say, let's go do it. If we're wrong, we'll give you the money back and walk away because we should know. We firmly believe in inspecting the property to get this done. In our space, some people like to do it off photos these days. I've done more than any of them, and I've probably got more data on than anybody in our space, and I don't believe we get the best result by just doing it off the photos that you provide. We go in there, we organise with the tenants, which is lovely. Organise a convenient time, go in there and make sure we get everything out of those. Your fees are tax deductions. We're actually a national business with a couple of hundred staff, so we do them all over, not just around the northern beaches. Next one, if we could. My BMT, just a simple way to find things. The thing I want to bring there is it actually brings in some, it's like when you do a schedule, this is where they live, this is where you can update them, this is where you can share them with your accountants inside a portal. The thing that's important probably in there to consider is those things are sort of important, but you can just ring us and we do it that way instead. However, there's some research and insights, valuations and things that come from the AVMs from the banks may not be good enough for the CGT issues going forward, but they give you some idea of where the values are sitting based on your properties that are in there. So if you've got schedules, use those. That's great. I think we're nearly there. Prop CAC I mentioned. Run some cash flows. Learn about what it looks like. Those cash flows I run, this is a way you can run it yourself for free as many times as you like. Compare different properties you're looking at and see what they should come in at with a few other metrics around your areas and things that get pumped in there from the same places, totality, etc., that the data comes from. I think that should be pretty much there with us, is it? Some apps. Look at those. They're in the system there. Download them. Depreciation estimates, prop calc, construction cost calculators. We do those things. Things that just make it easy on the investing journey for you to help you as you go and try to learn as much as you can. I think that should be be us at the end. Oh, process. One more. We talk to you. We make sure it's worth it. Before you do another tax return, if you've already got a property, give us a look at it, see if there's any deductions there so you don't miss out. Because if you do another tax return, you can only go back 2 tax returns. So if you are missing out, you want to see if you can take advantage of that. Get on the calculator and the app and see what sort of deductions, or just talk to us about it. We'll tell you whether we think we can find some money. It's all very easy. Talk to you about your properties, inspect the property, do a depreciation schedule, give it to your accountant, and get heaps of money. Process is pretty easy. I think we're there.
Wow, awesome. Well done. I think we've got a question here.
Quick question. Sorry.
Is everyone feeling rich now all of a sudden?
There are a number of properties in this part of the world where concrete cancer is affecting them, and the special levies that will be charged for those. How much of that is claimable?
So, plenty of concrete cancer. We live on the east coast of Australia. So at the end of the day, what you can do is claim things once. If you claim your special levy as a deduction, you can't depreciate the thing otherwise. It's the same as if you make an insurance claim for something and the insurance company pays for it and they're actually claiming it, you can't actually depreciate it as well. So it only gets dipped in one place. So if it's not claimed elsewhere, then it'd be claimable as depreciation. But if it's claimed elsewhere, then no, basically. They don't like just dipping twice, and that's fair.
Guys, any other questions before we wrap up? Yes.
Been here tonight, and for whatever reason, we're busy people and life's pretty hard, transport and all that. Will there be another one of these seminars?
Oh, we try and hold them regularly. Would you like to come back tomorrow night, maybe? No, we do. We hold them regularly. I think we've streamed it tonight as well, so you can download it if you would like to. But we do hold them as regularly as possible. So it's good to hear that you've enjoyed it. Thank you. Okay, guys, anyone else? Questions? Gav, question? No? Mark's got a question. Guys?
I think the main thing with property is you've got to look for those opportunities in changing times. And to look for those opportunities, you have to continually educate yourself. If you stay frozen in time with property, I think with anything, with any business, you're going to be left behind. It's going to cost you money if it's not going to make you money. So tonight, educating, talk to us. We're always available on the phone. Where's it going? What's it doing? It's about being ahead of that curve, because if you don't plant the seeds in now, it's going to cost you more after. So hopefully you've learned some things tonight through, different tax, super. I know some of the words are a little bit boring, but boring sometimes. It hurts if you sort of ignore it, I guess.
It's hard to find this sort of information. I think there's been like an information overload in the last 6 weeks. It's hard to try and find this information. Bradley, I think, is going to stick around for a little bit. Yep, Maurizio is going to stick around for a little bit. Can we just say a big thank you to these guys? They actually gave up their time tonight to come and help us. And also, I just want to say a massive thank you to our crew. It was chaos here today trying to set up amongst all the other things that we have to do in real estate world. So thank you to our team as well. We really appreciate it.
Now, if you scan with your phone all those things that you can't read will come up onto your phone, so you can't read them on your phone. No, they'll come up on your phone. You can zoom up and stuff. But if the QR is there, press send after you do that. It goes straight to your phone and you'll have that forever. And there's a lot of good information there. But yeah.
And also, I just want to reiterate, Michael Bergio, can you just pop your hand up? So Michael heads up our commercial division, lots and lots of very valuable information. Michael will be around for any info. Billy is going to be around to talk about off the plan, which is huge at the moment, and also first home buyer stuff. And there's a whole lot of us here if you just want to come up and have a chat, property managers and all sorts of people. So if we can help you, please just come up and say hi. Thank you for giving up your time. We really appreciate it. Thanks so much.
Thanks.